Welcome back to the Deep Dive. Today we're looking at someone pretty fascinating, a really successful but also quite reclusive entrepreneur and investor from Asia, Duan Yongping.
Right, and maybe the name isn't, instantly household famous everywhere, but his impact, it's huge.
Huge, right? Founder of Subor, which is big in its day, and then BBK. And BBK, well, that's the parent company behind smartphone giants Oppo and Vivo.
Exactly. He gets called the Buffett of China sometimes, but unlike Buffett, he rarely speaks in public.
Which is why this recent interview is such a big deal.
Absolutely. He gave this hours-long public interview back on October 16th, 2025. It's a gold mine. We've really dug into it.
And you found some interesting patterns in just the words he used.
Yeah, it's quite revealing, actually. 3 words really stood out, and the interviewer even counted them.
Okay, let's hear them.
All right, so mistake came up 10 times. Understand was used 12 times. And then there's very hard. Get this, 29 times.
Wow, 29 times for very hard. That seems a lot. Almost defensive, maybe? For someone so successful, why focus so much on the struggle?
Well, that's exactly what we want to unpack for you, the listener, today. That's our mission here. How do those words mistake, understand, very hard connect?
Okay.
It all seems to tie back to this one core belief he has, this very simple idea that drives everything. Buying a stock is buying a company.
Simple,
Yeah,
but apparently very hard to do right.
precisely. So we're going to try and distill that consistent way of thinking, how he uses simple rules to navigate business, investing, life, really. Rules that are, apparently very hard.
All right, let's start at the beginning. His background. Born in Nanchang, moved around a bit in rural areas as a kid.
Yeah, about 5 or 6 times, he mentioned. Then an engineering degree, and later on a graduate degree in econometrics from Renmin University.
Did the econometrics shape his thinking much?
He kind of downplayed the specifics of it, said the main thing he actually got from his education wasn't the subject matter per se.
Oh, so what was it?
It was more fundamental. It was learning how to learn. That was the big thing.
Ah, okay, the meta skill.
Exactly. Building that confidence, the feeling that, okay, if I run into something I don't get right away, I can figure it out. I can learn it. He felt that really reduces your fear of the future.
So it wasn't about some grand ambition, just equipping himself.
Pretty much. Just having the tools to handle whatever came next. And that foundation, that learning mindset, it quickly showed up in how he approached business.
Yeah.
Non-negotiable standards.
Right, especially around integrity. We see that in his early career. First as Subor, then BBK.
Oh, definitely. The Subor story is quite telling. He talked about recruiting good people based on specific equity promises.
And then the terms changed.
Repeatedly. It went from 70-30 to 80-20, then even 90-10. He realized he just couldn't keep his word to the staff he brought in because the founders weren't keeping theirs.
That's tough.
Yeah. He said, point blank, you need credible contracts, sure. But more than that, founders have to say what you mean, do what you say, without that basic trust. Well, that's why he left Subor.
So leaving Subor over that lack of trust,
Yeah.
how different was it when he set up BBK? Did they really build that integrity into the culture?
Oh, massively different. It was foundational for BBK. Honesty, being totally focused on the user, and this vision of being healthier and longer lasting, not just chasing quick wins.
Healthier and longer lasting. That's an interesting goal for a company.
It is. And crucially, it meant setting clear boundaries on what they wouldn't do. Anything sketchy, unsustainable, short-term, it's just off the table.
Which brings us back to that idea you mentioned earlier.
The power of not doing.
The opposite of how most people think about success.
Right. He pointed out that usually people focus on the brilliant things they did, but he genuinely believes a huge part of BBK's success and his later investment success came from all the things they consciously chose not to pursue.
Avoiding bad paths.
Yeah. Avoiding stuff that was too complicated, maybe ethically murky, or just didn't look profitable long term. Learning from painful lessons, knowing when to just walk away.
That principle, not doing, avoiding what you don't understand or what lacks integrity, seems like a perfect setup for his investing career later on.
It really does. After he retired, moved to California, apparently got bored. He said you can't play golf 24/7.
Fair enough. So how did he apply that same filter, that not doing discipline, to the stock market?
Well, he started studying, looking into it, but he immediately threw out technical analysis, chart reading.
Why?
He just, he couldn't get it. Said he literally couldn't understand how they drew those lines. As an engineer, he wanted logic, fundamentals. It felt arbitrary to him.
Okay, so no charts. Then what?
Then came the light bulb moment. He read one single sentence from Warren Buffett, and he said that's when everything just clicked into place.
Let me guess. Buying a stock is buying a company.
That's the one. That single idea became his entire investment philosophy. Simple, right?
Sounds simple.
But this is where the very hard part comes in. Remember those 29 mentions? He really stresses why that simple sentence is actually incredibly difficult to execute properly.
Okay, explain that. Simple idea, hard execution. Why?
Well, simple because the instruction is clear. Look at the actual business. Understand its customers, its competition, how it makes money, what its future cash flows might look like.
Right. Focus on the business, not the stock price ticker.
Exactly. But the hard part, he reckons very, very few people. His estimate was less than 1% of people on investing platforms truly internalize that sentence.
Less than 1%. Wow.
Yeah, because he argues most companies are just really complicated. They're not easy to understand deeply. So what happens? People give up on the hard work of understanding and just fall back into trading, speculating.
It's interesting because most beginners, I think, they look for bargains, right? Cheap stocks. But he sees cheapness differently.
Totally differently. He was quite forceful on this point. He said, cheap things can get cheaper. Cheapness isn't safety.
So what is the margin of safety then, in his view, if it's not buying cheap?
It's understanding. He argues Buffett's real margin of safety isn't about the price you pay. It's about how well you understand the business, its model, its resilience, its future. If your understanding is rock solid, that's your safety net, even if the market price bounces around like crazy.
Okay, so understanding is key. But he also called it a gray zone, didn't he? Meaning it's not always black and white.
Yeah, exactly. It's not like you suddenly achieve perfect 100% understanding. It's a spectrum.
Can you give an example of where he felt he understood enough to bet big, but still acknowledged it wasn't perfect?
Sure, his Nitty's investment is a great case study. This was early on a really heavy bet for him, almost like venture capital.
What did he see there?
He met the team, saw their passion, how serious they were, and crucially, he noticed the company had more cash just sitting there than its entire market cap.
Basically trading for less than the cash it had.
Pretty much. So he bought a lot, and it just exploded, went up 20 times in about 6 months. Huge win.
20-fold.
Ew!
In 6 months. That's incredible.
It really is. But here's the thing. Even after that kind of success, he looks back and says, with humility, if I had truly understood it, I would have bought the whole company.
Huh. Okay. So even with a massive win, he felt his understanding was still incomplete.
Exactly. It was good enough, clearly, but not total, which brings us right back to that theme of mistakes.
Right. The idea that mistakes are just part of the process.
Totally built in. He basically says everyone makes mistakes. The probability isn't that different from person to person.
So what is the difference then between successful people and others?
2 things, he thinks. 1, not digging yourself deeper when you realize you're on the wrong path. Don't double down on a mistake.
Cut your losses, conceptually at least.
Right. And 2, just try to make fewer big mistakes over time. And a key way to do that is by avoiding the really complex stuff you don't understand in the first place, sticking to your circle of competence.
And this loops back to culture, doesn't it? Culture is the thing that helps you recover from mistakes. The North Star, he called it.
Yes, that's the anchor. When you inevitably screw up or the market throws you a curveball, a strong culture helps the company find its way back to the right path.
He used Apple as an example, right?
Yeah.
The company he invested in back in 2011.
He did. He bought Apple partly because he saw the potential in their services revenue really early on. He called it a visible elephant.
And he admired their culture.
Deeply. That intense focus on the user, the quality, the long-term value. He acknowledges they make mistakes like being slow on bigger phone screens initially.
Yeah, I remember that.
But that core culture, that obsession with quality and user experience, it eventually corrects those mistakes. It steers the ship back.
That kind of resilience must have been tested at his own company, BBK, during that really rough patch around 2012, 2013.
Oh, definitely. The shift from feature phones to smartphones was brutal for them. He talked about it, frankly.
Why not?
Feature phone sales just fell off a cliff almost overnight. Their cash reserves took a massive hit. They were losing a lot of money.
How did they handle it from a leadership perspective? He had already delegated a lot by then, right?
Yeah, he believed strongly in delegation. The CEOs of the different divisions like Oppo and Vivo, they made the calls and owned the results. That was crucial.
And his guidance during that crisis?
It wasn't about cutting corners or desperately chasing sales. It was pure culture, pure integrity. He told the team, if we go down, do not go down ugly.
Don't go down ugly. Meaning what exactly?
Meaning, don't screw over your suppliers, don't mistreat your employees just to save a buck. Even if the ship is sinking, maintain your integrity. That ethical boundary, that was the anchor that helped them weather the storm and eventually pivot successfully to smartphones.
That focus on integrity makes his decision to sell General Electric in 2008 even more striking.
Yeah, that's a fascinating story. He actually admired GE, especially under Jack Welch, for its focus on integrity.
Boy, he sold it. Why?
He noticed something small but significant. They removed the core integrity motto from the company website.
He removed it.
Yep. And for him, that was a huge red flag, even though he actually made money on the trade when he sold.
He still called it a mistake. No, wait, the opposite, right. He sold because of the change.
Right, he sold because of the change. It wasn't about the financials at that moment. It was a cultural signal. A company that stops emphasizing its core values, its North Star, that worried him deeply. He saw it as drifting into risky territory.
Okay, so moving from corporate values to the digital age, what's his take on the AI revolution that's happening right now? Is it real or just hype?
Oh, he's definite on this. It's absolutely an industrial revolution, no question in his mind.
But with caveats.
Well, yeah, he acknowledges that, like any big new tech wave, it comes with bubbles attached, hype cycles, but the underlying shift, it's massive.
How does he describe the scale of it?
He talks about it as computing power scaled up by like hundreds or thousands of times. This creates what he called terrifying efficiency.
Terrifying efficiency examples.
He mentioned things like drug discovery, potentially going from years down to days. He even uses AI himself now to quickly get the basics of a new company he might be looking at.
But that efficiency, it implies disruption, right?
Yeah.
Especially for jobs.
Absolutely. He's pretty blunt about it. He thinks AI will disrupt a lot of jobs, writers, designers, filmmakers, many analytical roles.
So what's the takeaway for people then? Especially, say, people mid-career.
His advice is stark. Adapt. Keep learning. Relentlessly. He specifically mentioned people over 40. If you stop learning, if you think you know it all, life is going to get very painful very quickly.
Okay, adapt or become obsolete.
Nah.
What about AI and investing? Will algorithms just take over? Will his style of investing even work anymore?
He thinks his style, buying great businesses based on intrinsic value, will still work. AI doesn't change the fundamental quality of a great company.
But
Forwarders. People playing short-term movements, looking at charts. He had a pretty brutal warning.
what was it?
He basically said, if you're trading on charts and technicals, you're the crop. The quants are the harvesters. The algorithms will just be faster, more efficient at scalping those tiny edges than any human.
Ouch. The crop and the harvesters? That's vivid.
Yeah. Investors who buy businesses, they don't really care about those millisecond fluctuations. Traders do. And AI is going to dominate that game, he believes.
So if you're an ordinary person, not a quant genius,
Yeah.
and you want to invest without being, well, hardested, what does he recommend?
Keep it simple. First, don't trade stocks actively. He cited the statistic that something like 8 out of 10 retail investors lose money when they try to trade frequently.
Okay, so avoid active trading unless you really know what you're doing.
Right. And if you genuinely feel you don't understand business well enough to pick individual companies, he says the best, safest long-term options are probably just buying an S&P 500 index fund or buying shares in Berkshire Hathaway. Let Buffett do the work for you.
Or, if you do feel you understand the business,
Then buy quality companies. Understand them deeply and hold them. Think in decades, not days or months.
like his holding in Kuaichao Mutai, the Chinese liquor company.
Exactly. He sees Mutai as almost beyond typical analysis. It's not just a bijou that's the spirit type, it's a cultural institution.
A category of one, almost.
Sort of. It has this deep cultural resonance, powerful brand, scarcity. For him, if you're thinking long-term, decades out, the day-to-day macro noise matters less. A great company like Mutai yielding maybe 3–4% in dividends, that's a much better place to have your money than just cash sitting in a bank eroding with inflation.
Okay, that makes sense. Before we wrap up, we should touch on his views outside of business and investing, his philosophy on life, on parenting.
Yeah, and it connects back surprisingly well. His personal goal, very simple, not world domination, just wants to live each day well, do things he enjoys.
And that simplicity carries over to raising kids.
Definitely. He said the absolute most important thing a parent can give a child is a sense of safety. Full stop.
Safety. How does that translate into practical advice?
Well, it leads to a strong not-to-do list for parents. Hitting, yelling. He says those things only reduce that feeling of safety. They teach fear. maybe compliance out of fear, but not real understanding or obedience. And kids who grow up fearful, he observed, tend to grow up unhappy.
He had a personal story about that, didn't he? About hitting his son.
He did. He shared that he tried it once out of frustration, instantly regretted it, apologized to his son right away, and promised he would never, ever do it again. And he stuck to that promise.
Wow, that takes humility.
It does. And he also mentioned learning from his son. There was a time his son was crying and he told him to stop. And his son apparently replied, "Dad, just let me cry a bit."
Huh. Kids can be wise.
Right. It was a lesson for him. Sometimes parents need to just allow the emotion, let it pass, rather than demanding instant control or suppression.
It really does all seem to tie together, doesn't it? This simple, hard wisdom of Duan Yongping, whether it's running BBK, investing in Apple, or raising his kids.
It's consistent. Understand the fundamentals, whether it's a business model or a child's needs. Set clear boundaries what you will and won't do. And always, always maintain integrity as that cultural North Star.
That's a great summary. It feels like the core really comes back to that initial lesson from university.
I think so too. That confidence that you can learn, you can figure things out. And if you connect that back to his warnings about AI in the future.
It's all about continuous learning.
Exactly. His biggest piece of advice really wasn't about stock tips. It was about adaptation. If you aren't actively, continuously learning, you're basically setting yourself up for pain down the road.
So, the final thought for our listeners to chew on.
Maybe it's this. We talked a lot about his focus on the not-to-do list in business and investing. But maybe think about your own life. Beyond your portfolio, what's on your personal not-to-do list? What boundaries are you setting to preserve your own integrity, your own focus, and your ability to keep learning and adapting in this world that's changing so incredibly